Welcome to Celebrity Investing, your go-to source for insights, tips, and updates on navigating the exciting landscape of personal and global finance. Please like, share, and subscribe for more exclusive content. This is part 2 of Mastering Asset Allocation. Strategies for effective asset allocation. Navigating the world of investing can be a bit like a roller coaster ride. Allocating your assets effectively can help smooth out the bumps and make your financial journey more predictable. Knowing how to balance your investments according to different strategies can mean the difference between reaching your goals and falling short. Let's explore a few strategies that can guide you in mastering asset allocation. Strategic asset allocation. Think of strategic asset allocation as your investment blueprint. It's a plan you create to reach your long-term financial goals. Just like an architect designs a building, this strategy sets the foundation for how you want your portfolio to look. Long-term focus. This approach is based on establishing a target mix of assets that align with your risk tolerance and investment horizon. Once set, the allocation is typically maintained for a long time, with only occasional rebalancing. This strategy helps you stay on course, unaffected by short-term market fluctuations. It's your financial GPS that keeps you on track to your destination. Tactical asset allocation. While strategic allocation holds the blueprint, tactical asset allocation adds a twist. It's like having a weather forecast that helps you tweak your travel plans. Tactical asset allocation involves making short-term changes to your portfolio to capitalize on market conditions. Short-term adjustments. This flexible approach allows investors to shift assets to areas that show potential for better returns in the short term. If you see a sector heating up, you might temporarily increase your exposure there. This strategy is about flexibility and seizing opportunities as they arise. However, it requires more attention and a willingness to adapt quickly to market changes. Dynamic asset allocation. Dynamic asset allocation is like sailing a boat in changing winds. You're continually adjusting the sails to keep moving efficiently. This approach allows for frequent changes in your asset mix based on your changing goals or market conditions. Flexible approach. Unlike the rigid structure of strategic allocation, dynamic allocation flows with the market's movements. It's proactive and requires you to be engaged with how your investments are performing. By being dynamic, you can potentially protect yourself from downturns while riding the waves of growth. Core satellite approach. Imagine your portfolio as the solar system, with a strong core holding everything together. The core satellite strategy uses this metaphor to enhance diversification while controlling risk. Core investments. These are the heart of your portfolio, typically stable and broad market investments that provide steady growth. Satellite investments. These are smaller positions, often in specific sectors or individual stocks, that aim to boost performance. The core provides stability, while the satellites add the potential for extra returns. This strategy allows you to keep a solid base while seeking out new opportunities where you see potential. Utilizing these strategies can help you navigate the ups and downs of investing with confidence and precision. Whether you prefer a stable path or a more dynamic journey, there's a strategy that can fit your style and financial goals. Rebalancing your portfolio. Rebalancing your portfolio is like tending to a garden. If you want it to flourish, you need to water, prune, and sometimes replant. In investing, rebalancing ensures your asset allocation stays in line with your financial goals and risk tolerance. Over time, some investments may grow faster than others, changing the mix you initially set. This change can expose you to more risk or return than you intended. Let's explore when and how to rebalance your portfolio to keep it healthy and thriving. When to rebalance. It's not always obvious when you should rebalance your portfolio. Regular calendar intervals or significant changes in your asset allocation can be useful signals. Here are some guidelines. Time-based intervals. One approach is to rebalance at regular intervals. Many investors choose to do this annually. This method is straightforward and easy to remember. It also prevents emotional decision-making during market highs or lows. Threshold-based rebalancing. Another effective method is to rebalance when your portfolio's allocation drifts beyond predetermined thresholds, such as a 5% or 10% deviation from your target. This approach can nip imbalances in the bud, ensuring your risk level remains steady. Market events. Significant market movements, like a sudden downturn or a bull run, can prompt rebalancing. These events can dramatically shift asset values, and being proactive can help manage evolving risks and opportunities. While these are common guidelines, it ultimately boils down to your personal strategy and how closely you want to manage your risk exposure. Methods of rebalancing. Once you decide it's time to rebalance, there are different methods you can apply. Let's take a look. Buy and sell. The most direct method involves selling overperforming assets and buying more of the underperformers to realign with your target allocation. This approach can incur transaction costs or capital gains taxes, so plan carefully. New contributions. This is a less intrusive method, where you channel new funds into the underperforming asset categories to rebalance without selling. This gradual approach can be cost-effective and tax-efficient. Withdrawals. If you are already in the distribution phase, withdrawing from the overperforming assets can help rebalance your portfolio. This method aligns with your spending needs, ensuring your portfolio sustains your lifestyle while maintaining its intended balance. Dividends and interest. Direct dividends and interest payments received from investments into underrepresented assets. This method leverages the cash flow from dividends without needing to sell assets. Rebalancing isn't just a routine task, it's a strategy to protect your portfolio from unexpected shifts. Like maintaining a well-kept garden, consistent rebalancing can lead to a more robust and potentially fruitful investing journey. Common mistakes in asset allocation. Mastering asset allocation is crucial for any investor aiming to achieve long-term success. However, many people fall into common traps that can derail their financial plans. Understanding these pitfalls can help you make smarter decisions with your investments. Ignoring risk tolerance. Risk tolerance is like your financial comfort zone. It's the level of uncertainty you're willing to stomach as you invest your money. Ignoring your risk tolerance can lead to a financial roller coaster that might not end well. Emotional stress. When the market dips, people who ignore their risk tolerance might panic and sell at the wrong time. Missed opportunities. Playing it too safe can lead to missing out on potential higher returns. Overexposure. Taking on too much risk can mean huge losses when markets don't go your way. Are you the type who loses sleep over every market flutter? Then keeping things low risk might be your best bet. Overreacting to market changes. It's easy to be swept up by the latest headline or sudden market movement. But when emotions take the wheel, your investment strategy can skid off track. Buy high, sell low. Reacting impulsively to market changes often means buying stocks when they're pricey and selling when they're cheap. Abandoning plans. Chasing trends might lead you away from your original strategy that was carefully crafted to meet your goals. Increased costs. Frequent trading incurs transaction costs that nibble away at your returns. Think of your investment plan as a well-charted roadmap. Stay the course and don't take unnecessary detours because a shortcut seems tempting. Neglecting diversification. Imagine putting all your eggs in one basket. If you trip, you risk losing them all. This is what happens when you neglect portfolio diversification. Concentrated risk. With all investments in one area, your portfolio is vulnerable to any downturn in that sector. Lost balance. A lack of diversification means missing out on potential gains from other sectors or asset classes. Volatility extremes. A non-diverse portfolio rides the highs and lows much more intensely, which can lead to poor decision-making. Diversification is like a safety net for your investments. It spreads risk across various assets, reducing the impact of any single loss. By maintaining a diversified portfolio, you're not just counting on one area to thrive, you're giving your investments multiple paths to grow. Embracing these insights can help you navigate the complex landscape of asset allocation with ease. Remember, avoiding these common mistakes can make all the difference in reaching your financial dreams. Mastering asset allocation is a cornerstone of investment success. By understanding and balancing risk and reward, investors can optimize their portfolios for long-term growth. Each financial goal requires a tailored approach, and a well-thought-out asset mix plays a pivotal role in meeting those objectives. The key is education and awareness. By staying informed and proactive, you put yourself in a position to make smarter investment choices. Utilize the insights shared here as a guide, and consider taking action by revisiting your own asset allocation strategy. Ask yourself, are your investments aligned with your goals? As you ponder this, remember that the landscape of investing constantly evolves, and your strategy should too. Share your thoughts in the comments and join the conversation on crafting the perfect portfolio. Thank you for joining us on this journey. Your investment success begins with the choices you make today. Stay tuned and continue to watch our videos to gain valuable insights into the world of finance. Subscribe, like, and share to continue your journey to financial success.